Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So, very interesting today in the markets. If you looked at stocks and bonds today basically were ripping in the middle of the day. We had yields really plunging down lower, especially the short end of the bond curve was rallying, pushing those yields lower. You had the market start to price in basically now 100 basis points of rate cuts that is expected to come next year. And you also had, while bonds were rallying aggressively, you also had stocks rally aggressively as well. And what was it? What was the trigger point for stocks and bonds to all rally? And basically the US dollar to sell off. The key fundamental catalyst that came out today, the news headline that came out today, was Fed Waller talking about potential rate cuts. Now, what did Fed Waller say? Fed Waller came out and he said that if we get a couple of months, right? We don't know what that means. What does couple of months mean? But it could be 3, it could be 4, it could be 5. But if we get couple of months of low inflation and we reach to our target, we can start talking about cutting rates. We can see the policy rate definitely. He said this in a way where he said you can see the policy rate definitely come down. Basically hinting that next year, if we see from now until a couple of months of next year, if we see a couple of months of data of low inflation, you can start to expect the first rate cut. Now, of course, if inflation doesn't come down, if inflation is still, up there, then sure, you expect the pause to continue. And of course, if inflation picks up aggressively, then expect some sort of hike. But you got the first Federal Reserve members start to talk about and slip in a potential of rate cuts, which basically caused stocks and bonds to rally because of this optimism, right? Especially equities love to hear that rates are coming down, cause stocks to basically rally, and of course bonds as well. And you had the bond market start to price in that, okay, according to Fed Waller's comments, we're pricing in 75 basis point rate cuts, we expect now we're going to see 100 basis point rate cuts. Now, at the same time, what was very interesting is that Fed Waller also mentioned about the economy as well. So not just rate cuts, but also mentioned that, he can expect to see going forward for next year, the economy to start to really slow down. Hence, why it would make sense to start seeing some sort of rate cuts. And you're starting to see the narrative and what is being told out there, right, from the Fed, that, obviously they're in pause mode. Obviously they come out and say we still need inflation to go back to the 2% target. But Fed Waller said that with the economy slowing down, he definitely sees inflation coming to the 2% target. And if inflation comes to that 2% target and we see a couple of months of weak inflation numbers, then yes, expect that rates would not be where it is. They would come down. Now, what the stock market, I would say, not the bond market, but what the stock market's not understanding, even though it might be rallying and there might be euphoria in the markets and optimism about rate cuts, is that why would there be 100 basis points of rate cuts or further? And what does it mean by Fed Waller saying the economy is slowing down? Are we talking about a soft landing or a hard landing here? Now, if it's a soft landing, which happens very rarely, then sure, you can, if that is being engineered perfectly from the Federal Reserve, then 100% this is very positive for equities. But what equities don't understand from the price action although markets can remain irrational longer than you and I can remain solvent, and sure, markets can continue to rally until there is some sort of credit event, black swan event, that basically throws the equity market off guard and causes selling and panic to come in. Now, if you look at how the stock market was trading before the comments from Waller, what was very interesting, especially in the Russell 2000, you tend to see selling, aggressive selling right at the market open at 9:30 a.m., especially in the Russell 2000. And you see the bond market the past couple of days start to pick up a bid and rally. Now, obviously, the bond market's picking up a bid and starting to rally because the bond market's pricing in rate cuts. And you could argue that this might be the bottom in the bond market, hence why you're seeing this continuation of a rally in the bond market. So if you look at the prices, you're starting to see it steadily go up as those yields come down, because the bond market is seeing that, yes, next year we're going to get some sort of rate cuts. Very unlikely that rate hikes will come. Of course, they can be wrong, and they have been wrong in the past, but you're seeing the consensus in the markets from bankers, from analysts out there, right? From the economists. And now you have even key members in the Fed, right? The Federal Reserve members out there coming out talking about potential rate cut scenarios. Now, this is the first one, right? And they're going to push back on it a couple of times here and there, especially Powell, because they don't want to create too much easing conditions too early on, because they do want to tackle the inflation, bring down the inflation level. But you will start to hear it more when things start to get worse off, especially next year. So what the key question is going to be heading into 2024 is going to be, okay, is this a soft landing or is this a hard landing? Because if this is a hard landing, then yes, 100%, you're going to see the economy slow down, and you're going to see the inflation level reach back to the 2% level. Like Fed Waller said, right? He said that, he sees that the inflation level hitting 2%, which would allow rate cuts to come in. Well, if that's the case, right, either you really think it's a soft landing, which tends to be in history a low probability, but I think that it's likely to see that we might see a hard landing. And I think the Fed members are also seeing that there is stress starting to creep up slowly. And that's what's going to create the slowing down in the economy to all of a sudden maybe a halt, which then causes, yes, 100% inflation to really drop, those metrics to really drop, to reach to your 2% target, maybe even go below that. And then, of course, the reaction would be to cut rates and so on. But then by then it would be too late, because you would be creating this event, this black swan event, or this credit crunch that would possibly panic the equity markets, right? If we're talking about a similar path like many recessions in the past, if we're talking about a similar path like what we've seen back in 2007, 2008 and onwards, like we saw in the dot-com bubble bursting, same thing with COVID 2020 and so on. You see these past cycles in the past repeat itself, and you tend to see how hard landings play out, and you tend to see how rate cuts come in times when things are getting worse off. So that's going to be the key looking at for next year. And already you're seeing some signs in the banking sector, right? Already you're seeing signs of commercial banks out there starting to tap into the excess cash that's needed from the Fed to keep liquid. And generally when that happens, right, when that happens, you tend to see that when banks are becoming more defensive, you tend to see that they are basically projecting a slowdown and a demand crunch. So if this is the same scenario back in like 2007, 2008, where more and more banks are needing that help from the Fed to increase their cash reserves there, right? Using the facilities out there, the BTFP and so on, then yes, 100% you're going to see, some sort of event play out later on, just like how history has shown. Now history may not be exactly right, like what we might see today may not be exactly like history, but it often rhymes, right? So very interesting to see that we heard from Fed Waller come out with these comments about rate cuts, and it's starting to look like that the Fed and the banking sector and everyone around and the bond market is starting to expect that these rate cuts are going to come, because maybe there might be a hard landing. And if that's not the case, right now I do agree that the markets, especially the equity markets, the consensus is that they're pricing in a soft landing, and that itself is going to be thrown out the window very quickly, and that itself can cause a massive shock in the equity markets, because no one's expecting the recession, right? Because remember, everyone was expecting the recession to happen last year, right? They're expecting it either to happen last year or this year, and it didn't come. Although you might argue that, hey, we are in a recession, I totally get it. But what I'm saying is that how the market is pricing in and how it's trading and how it's reacting is that it's reacting and trading like as if this is a soft landing. We are in a soft landing. 100% we are right now in a soft landing, but that doesn't mean that we can't turn from soft landing to hard landing. So anyways, very interesting to hear those comments from Waller. We'll continue to assess how things play out month by month in terms of inflation and data, macro data, and so on. We're going to get some more, especially heading into December. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.